So, Vince, you've got Star Wars hitting theaters in, I don't know, a week? Sooner?
To about less than 3 weeks.
Yeah, okay, so 3 weeks, sorry. Captain America Civil War coming out next spring.
Trailer just hit
The
for
trailer.
That. Sure.
What'd they get, like 51 million views? And
Crazy
whatever?
number of views over a very short amount of time.
You would think that Disney stock, which happens to own both these massive franchise properties, would be doing super well these days, but that's not the case. So what's going on?
The thing is, the stock is still doing pretty well for this year. Year to date, it's still up over 20%. But in the past week or so, it's taken a bit of a dive from about $120 per share on November 20th to about $113 as of trading earlier today. And a lot of that hit has come from the filing of its 10K. And because in that filing, it revealed what a lot of investors have been worried about, and which really dinged the Disney shares in August, I think it was, when Bob Iger basically made the comment, CEO Bob Iger made the comment that, we're going to be losing some subscribers from our media and networks division, and that trend really continued. So
how bad was it?
So basically, when people think Disney, think about the movies, the parks, but its biggest business is the media network segment, which made up 44% of revenue, 53% of operating profit, and this is for fiscal 2015.
Well, not only that, and I highlighted the movies, and they're obviously going to make boatloads of cash off of Star Wars and Marvel and Captain America and all that stuff, but those are one-time things. The consistent cash cow is ABC's. Their networks.
Yes.
And this is not good.
So ESPN, is like the crown jewel of all their offerings. It is able to command, just the importance of live sports to viewers. It's probably one of the main things holding out.
It's the one reason to have a cable subscription.
It's like the one thing that's really stalling, I think, the cord cutting trend. And, ESPN is able to command tons of money. But the problem is, over the past 2 years, the subscribers just at ESPN have fallen from 99 million to 92 million, and 3 million of that loss took place in the past year. So people kind of knew, all right, well, this trend's is taking hold. We expected losses, but this is at a much faster clip,
right?
Than what
Were
the
they
market was
expecting 1 million a year? Like what did they actually think would happen?
So, and the thing is, down from 99 million to 92 million at a faster clip than everybody was expecting. And over that same period, some of the other networks, ABC Family shed 5 million subscribers. Disney and Disney XD, their domestic channels, each lost 4 million. And the thing is, Disney also has a 50% stake in channels like A&E, Lifetime, History, and they're all down 5 to 6 million consumers over the past few years as well. Or subscribers, excuse me. So it's not looking good at all.
Right.
And the thing is, the effect of these declines is becoming more pronounced. Again, over that same 2-year period, media networks, their overall revenue was up 14.3%, which is pretty good, but it lagged the overall top line, which saw growth of about 16.5%. And operating income growth is really where you see it, and this has to do with like rising costs for that segment. Operating income growth was up 14.3% for media networks, but overall, it was 36.9% for the company. So a lot of the other segments are making up for that stall.
Right.
And here I look at it now, it's like, okay, so now we're actually presented with a serious, like, long-term challenge for this company. Like, a lot of times people will bring up things that ding the stock, but this is actually something that could really hurt the company if it keeps going down from 99 to 90.
You would almost prefer to be the cable provider like a Comcast or something, because at least they get you for your internet, which you still need these days.
So the thing, I think there are some projects that Disney has in pipeline and options that they have that will stem the losses. But at the same time, investors really do need to ask themselves, okay, I understand that ESPN is live sports in general are very valuable for these content providers.
What's ESPN been valued at on its own? It's like 50 billion or something crazy.
Serious, like crazy numbers. And the thing is, as true as that is, the company has had to pay more to keep ESPN outfitted with content. So, for example, rights to NFL games increased from $1.1 billion to $1.9 billion annually as of the deal they signed last year. And for the NBA, for the season, the 2016 to 2017 season, again, ESPN's paying 200% more than their previous contract because honestly, every other network recognizes the fact that, hey, live sports, you can't replace that with a streaming
Right.
service. We need that to bolster our numbers, so they're bidding up more for it, and as a result, ESPN's paying the price too.
Wow.
So,
But they have to.
Yeah,
like, that's
exactly.
game over.
As a result, the company has tasked ESPN with trimming $100 million from its budget next year, an additional $250 million for 2017. And so for me, I'm just thinking, investors need to ask themselves some questions like, what is the bottom for these subscriber losses? Now, I don't think that it's just going to keep going down and down until zero. That's crazy,
Right.
because people do want live sports. It has proven itself to be a bit of a holdout for anybody else who's been considering cord cutting. But where is that bottom? And once we have a better grasp of what that number is, how big of an impact does it have for a segment that makes up over, half of operating income? And something else to keep in mind is, do the high potential of upcoming projects, like you mentioned with theme parks, upcoming movies, are those enough to make up for that hole that's left there?